Good morning, everyone. It is Friday, January 19th, half an hour before the market opens. I apologize if you hear noise in the background. My cleaning staff is still here, and it's my my wife's birthday today, so I got to remember that for later. Uh, let's take a look at what's happening in the markets. Yesterday, we saw that bounce off of moving averages in the QQQ and the SP 500. We want to see if that momentum carries forward and continues into the weekend. And then after the weekend, if it continues after that, then we'll believe that we're still trending higher in this market. If we don't, if we kind of stagnate or if we start pulling back, then we're looking more of the possibility of just chopping sideways or that pullback that we've been anticipating for a little while. We've got little mini pullbacks along the way, but not the deep pullback that we're really expecting for this market to be able to just start really moving higher. So let's go. Hopefully you can still hear me. I apologize for that. So if we go to our futures, we can see that we're up fairly significantly, almost 50% or half a basis point. Sorry, 50 basis points, half a percent on the S&P 500, and pretty close to, let's see, this is probably like 60 to 70 basis points on the NASDAQ, and actually maybe even closer to 80. And then Dow Jones about 50 basis points again. We are up significantly, non-random. We are seeing an upward momentum, and if this continues and earnings are really good and start to go higher, especially once we hit the tech stocks in about 2 weeks, then this market we would say is really, really strong. The reason why we would consider it really strong is because it's starting to deviate. Well, I can't say it's starting to. Yesterday we deviated where the tech stocks rallied despite the bonds coming down. The bond is the strong natural force, but earnings are the major force within the equities markets. Interest rates, bonds, they have an effect. That's why we have things such as a monetary policy, but corporate earnings are the underlying driver of the equities markets. The interest rates are the environment that it grows in. So it's kind of like saying, if I have a really strong seed from a really good growing plant, if I put it in fertile soil, it'll grow really, really, really well. But if I put it in not so ideal conditions, it'll still grow to be a strong plant because it came from a strong stock. You see that? So the stocks are driven underlying first by the corporate earnings and then by the interest rate environment. But of course, if the interest rate environment is super hostile, it doesn't matter how strong that seed is, it'll still wither up. For now, what we're seeing is that TLT continues to move down. If those corporate earnings are really, really, really good and overcome this downward motion in the interest rates, then the market is super strong. Because at some point, when that interest rate stops going down and starts to flatten, then that's an even better environment for a market that is really strong and it can continue to move higher. We don't know that yet. What we're seeing is the divergence of possibilities. So it's a higher risk environment for us because we could get really directional in either way, in either direction. When we look at the S&P 500, you see that we've been chopping sideways. We could get really directional upwards, or we could break down and start pulling back. But what we know for now is that it's going in a sideways channel. So it could keep doing that for a while before it decides which way it's going to go. We don't have what we had before, which was these +3 ATR. +3 ATR. You see how what I told you is when it hits that +3 ATR, we expect it to either pull back or chop sideways into the +1 ATR or lower. And that's exactly what happened right here. We chopped sideways instead of pulling back. And then we did it again over here. We chopped sideways and then we hit that +1 ATR. Then we had a little bit of a pullback and we're still chopping sideways from there. So we're not in this +3 ATR environment. So we're not expecting a super pullback immediately. But if we do break down below these levels, then that'll be the pullback or major correction that we get in this market. Remember, in a given calendar year, we expect 1 to 2, 5 to 10% corrections. And we haven't gotten, it's just the beginning of the year, but this run upwards was so strong and so high that we are expecting that somewhat soon we will get that 5 to 10% pullback. This just hasn't happened yet. This market has been really strong and resilient and just keeps on going higher. So we just want to be aware that we're not in this plus 3 ATR environment, but we are approaching these all-time highs, and we are due for that pullback. But it's not like it's not like this market is so overstretched that we really need it to either keep consolidating sideways or coming down. There is some room for it to go up. If we look at, we should go back and look at our bonds. Bonds are opening higher. I can't tell. Slightly, just a tiny hair bit higher. So nothing really significant. I'll call that sideways. The equity markets are looking strong. We may just remember the tendencies to pull back towards the previous day close. We may see initial weakness in the market in the first hour or so, but there's so much momentum right now. It's unlikely that we'll end up with a lower print today, meaning that it's unlikely that in the S&P 500 or the QQQ, especially, that our close will be below yesterday's close. That's not looking like too likely of a scenario. What we really want to see is, do we chop sideways or do we break above this green line right here, which would mean that we make an all-time high in the SPY and in the QQQ. Same thing. Well, it looks very clear that we're going to make an all-time high today since we're opening way up here. But does it continue with momentum to the upside? Today is Friday, so we're not expecting any earnings after market. Everything that was going to report already reported this morning. And then we don't have much on our economic calendar either. So I think that's about it for today. We're just going to watch out for initial volatility in the morning. We do have some smaller consumer sentiment. Consumer sentiment is somewhat significant today. That's in the first half hour of trading. There could be some volatility surrounding that. Otherwise, we just want to look for where did it go? Here we go. Let's do some levels. We haven't done that in a while in our S&P 500. So around yesterday's close and pre-market high, pre-market mid. Okay, so an important level that we've been reacting to in the pre-market. And see how we bounced off of this, bounce off of it, we bounce off of it. That's going to be likely to be an important level in the day trading today. And maybe this one's a lot more minor. And then I will pick this gap fill. So gap fill right here. Okay. So these are levels to look out for in the day trading action. If we break above these purple lines, then we'll have, with momentum, then we could get directional to the upside. And then again, I said that it's unlikely that we're going to actually close below yesterday's close. But if we do, then that's a lot of downward momentum in the markets. Okay. So that's it for this morning. I will see you guys in the aftermarket session.